Imagine standing in mission control. You just watched a multi-million-dollar rocket tear through the atmosphere. It deploys its payload into orbit, and it hits like every single technical milestone flawlessly. High fives all around, right?
Oh, absolutely. That's the dream.
Right. But then you glance over at the financial analysts in the corner of the room, and they are literally shaking their heads, tearing up their projections, and groaning.
Yeah, a complete paradox.
Exactly. The physical engineering is this massive triumph, yet the financial world is treating it like a disaster. Welcome to today's deep dive. We are looking at a huge financial disconnect happening right now with Rocket Lab.
It's a really fascinating situation.
It really is. We're pulling from their Q2 2026 SEC filings, some highly critical Wall Street equity research from AIM Partners, projections from the Motley Fool, and the latest aerospace industry reports to figure out what is actually going on behind the curtain.
Because the contrast between, what a company achieves in the vacuum of space and how it gets punished during trading hours here on Earth is just, it's one of the most interesting dynamics in modern business.
Totally.
We are looking at a company that is mastering orbital mechanics, but seemingly struggling to master market expectations.
Right. So Rocket Lab just posted record-shattering Q2 2026 results. We are talking about $234.1 million in revenue, which is up 62% year over year.
Massive growth.
Huge. And they are sitting on a staggering $2.36 billion backlog of orders. And yet, the moment these numbers dropped, the stock tanked 8% in after-hours trading. Okay, let's unpack this. Today, we are going to explore this valuation paradox for you, break down their, frankly, staggering $8 billion acquisition of Iridium, and look at the massive physical engineering hurdle standing in the way of their entire master plan, which is the Neutron rocket.
Yeah, to understand why Wall Street punished them despite that record-breaking top line, we really have to dissect where that $234.1 million actually originated.
Right, because it's not all just from launching rockets anymore.
Exactly. When you dig into the SEC 10Q filing, the revenue mix reveals a company that is just aggressively mutating. Their space systems division is the actual growth engine here.
Hitting, what, $189.5 million in the quarter?
Right, which is up 94% from last year, and that's because they've been on an absolute shopping spree.
Yeah, I saw that they acquired Mynaric, which brings laser communications in-house.
Yeah.
And motive securing precision space robotics. So, they aren't just a launch provider anymore.
No, not at all. And AIM Partners highlighted this transformation in their latest equity research. They explicitly labeled Rocket Lab the mini SpaceX.
Oh, wow. Mini SpaceX.
Yeah, because they are building an end-to-end moat that is incredibly rare for a publicly traded company. By integrating Mynaric's lasers and Motive's robotics, they are positioning themselves to not only build the satellite bus, but to, manufacture the critical high-margin payloads, integrate them, and then fly them on their own rockets.
Which is vital, right? Because their actual launch services revenue dipped slightly. I think it was down 4% year over year in the quarter.
It was, yeah.
But, and this is wild, the underlying unit economics on those launches are dramatically improving. They are pulling in about $9.1 million per launch, while the internal cost to fly is only $4.4 million.
So the core launch business is undeniably healthy.
Right. But here is the catch that sent Wall Street into a tailspin. Despite all these top-line records and the improving margins, the company posted a net loss of $49.2 million for the quarter. Analysts had modeled a loss of 3 cents per share, and Rocket Lab delivered a loss of 8 cents.
Yeah, and you have to remember, financial markets operate entirely on forward-looking expectations and, predictability.
Sure.
So when a company misses an earnings per share target by that wide of a margin, it signals to institutional investors that the internal cash burn rate is accelerating way faster than the revenue growth can actually offset it.
It's like getting a 98% on a brutal calculus final, but because your parents expected 100%, they take the car keys away.
That's a great way to put it.
And look at the valuation multiples they are trading at. We are talking up to 65 times sales. That's a price-to-sales ratio of 29 in an industry where the average is sitting at just 2.21. I honestly have to push back on this market logic. A valuation of 65 times sales just seems completely detached from reality for a company operating in an industry where the fundamental business model involves literally setting millions of dollars of hardware on fire just to get things into orbit.
I get that, but aerospace economics operate on a completely different temporal scale than, say, software or traditional manufacturing.
How so?
Well, you're looking at a sector that requires massive, sustained R&D capital expenditure up front. So
Yeah.
that 65 times multiple. It isn't a reflection of current cash flow. It is the premium investors are willing to pay for a future monopoly.
Ah, so they're buying the future mode.
Exactly. They are setting cash on fire today to secure this high-margin, utility-like dominance in orbital infrastructure for the next 3 decades. Investors are pricing in the structural advantage of that expanding moat. They're assuming that once the infrastructure is built, the barrier to entry for any new competitor will just be insurmountable.
Okay, well, if that sky-high valuation is heavily mortgaged against their future potential, we need to look at what Rocket Lab is actually selling to build that moat. Which brings us back to that $2.36 billion backlog.
Right.
They added over $1 billion in new contracts in Q3 alone, and the U.S. Space Force is the massive gravitational pull here. Payload Space reported a $397 million contract for the Space-Based Airborne Moving Target Indicator Program, or SBAMTI.
Yeah, and the SBAMTI program is a perfect showcase of why those acquisitions we mentioned earlier actually matter.
How does it tie in?
Well, the Space Force doesn't just want a dumb piece of hardware in orbit anymore. They want a persistent, resilient mesh network that's capable of processing tracking data in real time.
Which is where Rocket Lab's new Flatellites come into play, right?
Yes, exactly.
For you listening, these are flat-pack satellites designed to stack densely inside a rocket fairing, basically maximizing the payload volume. It's almost an IKEA for space strategy.
That's spot on.
But the payload itself is incredibly sophisticated. They are using onboard AI and low-latency communications to identify and track airborne threats dynamically, directly from orbit.
And that's where the integration of Mynaric's laser communications becomes the absolute linchpin.
So the low latency.
Right. Instead of relying on traditional radio frequencies that have to downlink to a ground station, get processed, and then get sent back up.
Which introduces massive lag.
Exactly, critical lag. These Flatellites can use optical laser links to pass heavy tracking data directly to each other while still in orbit. It creates this secure, space-based computing layer for the military.
Wow. And they also locked down over $160 million to build 3 geostationary satellites for the government, which is them completely breaking out of their traditional low Earth orbit comfort zone.
It's a huge leap.
It is. And they are expanding their physical footprint on the ground, too, introducing the Ghost Deployable Launch System with 2 new pads coming to Kodiak, Alaska by 2027. I mean, this level of expansion is staggering. But let's look at the operational reality here.
Okay.
Rocket Lab started out mastering the art of throwing small payloads into low Earth orbit. Now they are manufacturing geostationary spy satellites, coding AI target tracking algorithms, pouring concrete for Alaskan launch pads, and building solar panels. Are they spreading themselves dangerously thin by trying to dominate every single vertical? Or is this end-to-end integration the only way to actually survive the consolidation of the space industry?
I mean, it is an incredibly high-wire act, there's no denying that. But it perfectly encapsulates Peter Beck's ultimate strategic vision for the company.
To own everything.
Right, because relying on a fragmented aerospace supply chain introduces massive vulnerability. By aggressively moving to own the entire value chain, acquiring companies that manufacture star trackers, buying Solero for solar arrays, developing their own Max Constellation flight software Rocket Lab, insulates itself from external supply shocks.
Right.
And more importantly, it allows them to offer the Department of Defense a single, highly classified, end-to-end security envelope. A competitor who relies on third-party silicon or outsourced flight software simply cannot offer the Space Force the same level of integrated security.
That makes total sense. You eliminate the risk of a third-party vendor delaying a critical national security payload just because, a specific microchip is stuck in a global supply chain bottleneck.
Exactly.
You fabricate the components, assemble the satellite, load your own software, and launch it on your own vehicle.
The strategic advantage is undeniable. The financial reality of building a vertically integrated aerospace empire from scratch, however,
Takes an astronomical amount of capital. Which brings the conversation crashing right back into their cash burn problem and that Q2 financial paradox. How does Rocket Lab fund this massive geographic and technological expansion without diluting their stock to zero or taking on crushing debt? Here's where it gets really interesting.
Yeah, this is the big pivot.
In June 2026, Rocket Lab announced they are acquiring the legacy satellite communications giant Iridium for $8 billion. It's a deal structured as $27 in cash plus stock, putting Iridium's value at $54 a share, with an expected close in 2027.
And this merger completely rewrites the DNA of the company. The Motley Fool's analysis really zeroes in on this acquisition as the catalyst that will transition Rocket Lab from a capital-hungry growth narrative into a free cash flow positive powerhouse by 2027.
The math in the filings paints a pretty stark picture. So, over the trailing 12 months, Rocket Lab burned through $316 million in negative free cash flow and posted $183 million in GAAP accounting losses.
Right.
Meanwhile, over that exact same window, Iridium generated $288 million in positive free cash flow and a $93 million GAAP profit. So when you model the combined entity for 2027, projections suggest the new company will generate roughly $425 million in positive free cash flow.
It's a massive turnaround.
It's like realizing your ambitious robotic startup is burning through runway in the garage, so you just go out and marry a wealthy, established accountant to cover the mortgage while you keep funding your R&D.
Iridium is definitely paying the mortgage, absolutely. But what makes this corporate marriage fascinating is the structural pivot it enables. Iridium already has its constellation deployed and operational in orbit.
So they don't have to build it from scratch.
Right. They're already harvesting high-margin subscription revenue from satellite phones, maritime data, and aviation tracking. This acquisition shifts Rocket Lab's center of gravity from a capital-intensive hardware manufacturer into a high-margin recurring revenue services company.
Yeah, Peter Beck explicitly framed this as their Starlink moment.
Yeah.
Because SpaceX relies on the continuous subscription revenue from Starlink to fund the massive development costs of Starship and their, deeper space ambitions.
Precisely.
So Rocket Lab is buying Iridium to act as their internal cash printer. And it instantly gives them a massive footprint in direct-to-device communications, the Internet of Things, and P&T, which is positioning, navigation, and timing. Crucially, these are sectors where SpaceX hasn't yet established a total monopoly.
And securing L-band spectrum and an established PNT network provides a vital alternative to GPS, which, is a major priority for both commercial logistics and the Department of Defense.
Huge priority.
By internalizing Iridium's cash flow, Rocket Lab secures the financial independence needed to become a self-launching Tier 1 space power without constantly returning to the capital markets hat in hand.
Okay, so on the spreadsheet, it looks flawless. The Iridium merger supplies the cash, the Space Force contracts build the moat, and the vertical integration drives down the unit costs. But all of this financial engineering is entirely tethered to one massive piece of unproven physical machinery.
Yes, the Neutron rocket.
The Neutron rocket.
Neutron is the absolute bottleneck for this entire multi-billion-dollar vision.
Looking at the specs from spaceflight. Now, Neutron is a 43-meter-tall, liquid methane-fueled, medium-lift reusable launch vehicle capable of throwing 13,000 kilograms to low Earth orbit. It is the mandatory heavy lifter needed to deploy these massive new constellations, including those Space Force Flatellites.
It has to fly.
But the SEC filings show the window for an end of 2026 debut launch is actively narrowing. Everything hinges on critical testing slated for later this year.
The engineering challenges here really cannot be overstated, and the timeline is under immense pressure following some recent testing setbacks. In January 2026, a first-stage fuel tank ruptured during a hydrostatic pressure trial.
Wait, a failure like that during a hydrostatic test? That isn't just a minor software glitch you can patch over the weekend.
No, not at all.
When a carbon composite or advanced alloy structure fails underwater pressure testing, you are looking at a fundamental material science or structural engineering redesign. That requires new tooling, new fabrication, and months of delay before you can even think about introducing highly volatile liquid methane into the system.
The structural implications of that rupture strike right at the core of Neutron's design philosophy. You see, liquid methane is chosen because it burns cleaner than traditional RP-1 kerosene, which prevents soot buildup and makes rapid reusability feasible.
Right.
But containing cryogenic methane requires highly specific tank architectures. Redesigning that structure pushes the critical path of the entire vehicle development significantly backward.
So I have to challenge the stability of this entire financial house of cards then. You have a $2.36 billion backlog. Huge swaths of that revenue, like the dedicated launch deal Kepler Communications just booked for 2028, the Space Force's NSSL Phase 3 Lane 1 contracts, and those massive SB-AMTI Flatellite constellations. They are all completely reliant on a rocket that recently failed a fundamental pressure test and has never even seen a launch pad.
It's precarious.
If Neutron's debut slips deep into 2027 or 2028, what happens to the balance sheet?
The risk profile is extreme, and AIM Partners equity research points out exactly this vulnerability. A significant delay or, a catastrophic failure during Neutron's debut launch would immediately halt backlog recognition.
Because if they can't fly, they don't get paid.
If the payloads can't fly, the revenue can't be recognized. It severely weakens their forward revenue visibility and could shatter the investor confidence that is currently propping up that 65 times sales multiple. Rocket Lab is caught in a brutal tug-of-war.
Between who?
They are attempting to satisfy Wall Street's demand for aggressive quarter-by-quarter timeline adherence while navigating the unforgiving binary laws of orbital mechanics.
And Peter Beck has been very vocal about this tension, hasn't he? He explicitly stated that hitting the schedule for the very first debut launch is secondary to ensuring the system is engineered for Flight 10 and sustainable, high-cadence production.
Yes.
He even pointed directly to the disastrous outcomes of rushing aerospace development, referencing Blue Origin's recent New Glenn explosion on the test pad.
Beck is actively engaging in expectation management there. He is telegraphing to institutional investors that accepting a 6-month schedule slip is infinitely preferable to vaporizing a vehicle on the pad.
Which would be catastrophic.
A catastrophic explosion doesn't just destroy hardware. It triggers lengthy FAA investigations, requires massive pad rebuilds, and destroys customer confidence. He is prioritizing the integrity of the long-term production line over short-term quarterly optics.
Because if Neutron doesn't fly, their entire vertical integration strategy just implodes. They would be forced to pay competitors, likely SpaceX, to launch their heavy space systems payloads. That completely destroys the internal profit margins they're trying to protect, and it undermines the very reason they bought Iridium in the first place.
It creates a cascade failure across their entire business model. The internal synergy relies on their ability to self-launch. However, we do have to look at their track record.
Okay.
Rocket Lab has successfully navigated steep engineering learning curves before. Their smaller Electron rocket boasts a phenomenal 98% success rate.
That's true.
The existential question is whether their engineering teams can scale that meticulous reliability up to a medium-lift, cryogenic, reusable vehicle while operating under the crushing timeline pressure of a massive merger and billions in backlog defense contracts.
So, what does this all mean for you? When you look at Rocket Lab's Q2 earnings paradox, you are watching a company attempting one of the most difficult maneuvers in corporate history. They are no longer a plucky startup lobbing small satellites into orbit.
No, far from it.
Through the $8 billion Iridium acquisition, the aggressive roll-up of component manufacturers, and the massive Space Force contracts, they are engineering a financial and strategic masterpiece designed to rival the biggest players in aerospace. But no amount of brilliant financial structuring or strategic M&A matters if the physical engineering of the Neutron rocket fails to perform. The spreadsheet only works if the rocket actually flies.
It is the ultimate crucible for the company. And, it brings up a much broader implication about their future trajectory that's worth thinking about.
That's what I thought.
If Rocket Lab successfully digests the Iridium infrastructure and gets the Neutron vehicle flying at a high cadence, they will simultaneously become the operator of one of the world's largest commercial communications constellations and the primary manufacturer of AI-driven surveillance platforms for the U.S. military.
A dual identity.
Exactly. As they increasingly fund their commercial expansion through heavily classified dual-use defense contracts, will Rocket Lab's ambition to be an accessible global commercial service provider inevitably collide with their reality as a deeply integrated, heavily weaponized asset of United States national security?
Wow, that is a profound tension. You start a company with the singular goal of making space accessible, and you end up standing at the volatile intersection of global telecommunications and orbital military surveillance.
It's crazy to think about.
It really is. The physical challenge of escaping Earth's gravity might ultimately pale in comparison to the challenge of managing the geopolitical and financial expectations waiting for them in orbit. We'll leave you to mull that over. Thanks for joining us on this deep dive.